Trump just hit China with an unprecedented 245% tariff, calling it a response to what he described as retaliatory actions. The Fed isn't in a rush to cut rates, and it won't jump in just because the market is a bit shaky. Yesterday, the three major US stock indices ended the day roughly flat. Gold prices surged over the past week. It's now at $3,356.6 per ounce, up nearly $210 or about 6.7% in just 7 days. With risk and uncertainty on the rise, we are also seeing more interest in Bitcoin as a potential hedge. The selling activity right now is dominated by smaller investors, not large-scale whales. The whales, the most core and influential market participants, are not leaving. In my view, Bitcoin is showing early signs of stabilization, even as the broader macro environment remains uncertain. 245% tariff, and the Fed just walked away. What now? Hi everyone, nice having you here today. This week, Bitcoin is sitting at a key level, and if it breaks above 86k, it could mark the start of a real bull run. But while Bitcoin is holding its ground, everything else is getting hit hard. Here's what's happening. The US just slapped a 245% tariff on Chinese goods, and at the same time, the Federal Reserve made it clear they are not stepping in, even as the markets shake. These are two huge developments, and today we are going to break them down. What does that tell us? What's really going on in the markets right now? And, more importantly, what could they mean for Bitcoin? Let's take a closer look. Trump just hit China with an unprecedented 245% tariff, calling it a response to what he described as retaliatory actions. So what triggered this move? On April 11th, China responded to the escalating trade war with 125% tariffs on a wide range of US imports. And they didn't stop there. On the same day, China also put export restrictions on 6 refined rare earth materials, which the US heavily depends on for everything from tech to defense systems. These are materials used in everything from smartphones to fighter jets, so the fallout is serious. On top of that, Chinese regulators told domestic airlines to stop accepting aircraft and parts from Boeing, hitting one of the US most important industries. And that's not all. Just yesterday, April 16th, Fed Chair Jerome Powell spoke at the Economic Club of Chicago. And his message? Not what the market was hoping for. In 2 sentences, we are in a position where we can wait for more clarity. Market intervention is not under consideration. In short, Powell made it clear the Fed isn't in a rush to cut rates, and it won't jump in just because the market is a bit shaky. This wasn't just a cautious stance, it came against the backdrop of Trump's aggressive new tariffs. Powell warned these tariffs aren't a short-term tool, they are a structural shift in policy, and that shift could bring higher import prices, slower growth, and a resurgence in inflation across the board. He even said it himself, we could be entering a phase of both higher inflation and weaker growth. A tough combo for the Fed, which now faces a real policy dilemma. Raise rates to fight inflations, which risks hurting jobs, or cut rates to support jobs, which risks stoking more inflation. And here's what stood out. Powell shut down the idea of a so-called Fed put. In the past, when markets dropped hard, the Fed would often step in with rate cuts or liquidity. Not this time. The market is functioning in an orderly way, even amid uncertainty. It's not time for the Fed to intervene. He made it clear, the inflation might not go away quickly. Yeah, it's not looking good. It's especially frustrating because, as we talked about earlier this week, markets were starting to show signs of a rebound. We were entering what looked like a corrective phase. Sentiment was improving. There were even hints that the administration might be pulling back on tariff pressure. But that was yesterday. Now everything is shifted. Yesterday, the 3 major US stock indices ended the day roughly flat. You can see it on the graph. The Nasdaq dropped over 3%, the Dow fell 1.7%, and the Standard & Poor's 500 was down 2%. For the stock market heatmap, it's a sea of red. Big tech got hit hard. Microsoft and Meta each lost nearly 4%, and Nvidia dropped almost 7%. So, naturally, investors are running for safety, and you can see that in gold. Gold prices surged over the past week. It's now at $3,356.6 per ounce, up nearly $210 or about 6.7% in just 7 days. And it's not just gold getting attention. With risk and uncertainty on the rise, we are also seeing more interest in Bitcoin as a potential hedge. As traditional markets wobble, some investors are starting to treat Bitcoin not just as a speculative asset, but as a store of value, especially in moments like this. It's part of a broader shift, as more people look beyond the usual options to protect their wealth in these volatile conditions. But while traditional markets are getting hammered, what's happening with crypto? Let's take a look at Bitcoin. If we take a look at the liquidation heatmap, we can see that Bitcoin is still trapped in the couloir between 84.5k and 84k and 86k. On April 17th at 2 AM on the Coordinated Universal Time, the price attempted to break above the 86k resistance, but was quickly rejected. It dropped sharply to a local low near 83.5k and lost $2,000 within just 30 minutes of Powell's speech. 1 hour later, it rebounded and returned to its previous range. After that move, we can see visible clusters of liquidation levels in yellow, forming around 85k and just below 83.5k. The brightest yellow band above 86k represents a dense concentration of short liquidations. Since the drop and recovery, Bitcoin has entered a tighter consolidation zone between 84k and 84.5k. The price is now making smaller and smaller movements with shorter wicks and lower volatility, a typical sign that energy is building up for a significant breakout. This kind of compression between liquidation zones usually resolves in one of two ways. The upside breakout scenario. If Bitcoin pushes above 86k with strong volume, it could trigger a cascade of short liquidations, rapidly pushing price toward the 88k, 89k range, where more liquidation bands are clustered. And the downside breakdown scenario. If 84k support fails, the drop could accelerate as long as position gets liquidated, possibly retesting the 83.5k low or even falling toward the stronger liquidation cluster near 82k. Now, let's take a look at the exchange inflow, spend output edge bands indicator. This metric helps us understand who's selling, whether it's long-term holders or short-term traders. It gives us key insight into what is really driving Bitcoin's price action. And what we are seeing right now is pretty interesting. The selling activity right now is dominated by smaller investors, not large-scale whales. Let's break that down. The smallest group, known as shrimps, those holding less than 1 Bitcoin, are leading the selling activity, with 480 Bitcoin offloaded in a single day. Compare that to the largest whales who only sold around 70 Bitcoin in the same time frame, a relatively minor move. Even mid-sized holders, often called fishes and sharks, those with between 10 to 1,000 Bitcoin, are showing signs of joining the sell-off. But when you step back and look at the bigger picture, the real selling pressure is not coming from the whales or long-term holders. Instead, it's primarily from retail, mid-sized groups, and short-term participants. And here is the key point. The whales, the most core and influential market participants, are not leaving. They are holding steady, even in the face of macro stress and market volatility. In short, institutional players appear to be taking a wait-and-see approach, while retail investors are becoming increasingly active. At least for now, short-term market dynamics are being driven more by individual participants than by long-term holders. So, where does that leave us? In my view, Bitcoin is showing early signs of stabilization, even as the broader macro environment remains uncertain. Yes, fear has intensified since last week. The current Bitcoin Fear and Greed Index sits at 30, indicating a clear state of fear. That's slightly higher than yesterday 29, but lower than last week's 39 and last month's 34. Overall, market sentiment remains cautious, and investors are still uneasy about the short-term outlook. Price action continues to be highly reactive to headlines, especially those tied to Trump and the escalating tariff war. We will need more time and clarity to see if this recent stability can hold. But for now, Bitcoin is holding its ground. So, to wrap things up, markets are clearly on edge. The trade war just escalated, the Fed isn't stepping in, and volatility is rising across the board. But in the midst of all of that, Bitcoin is showing resilience. Despite short-term sell pressure, long-term holders and whales are staying in. We are seeing signs of accumulation, growing interest as a hedge, and a market that's starting to stabilize, even if the macro picture is far from certain. We will be keeping a close eye on how this unfolds in the coming days. So if you found this helpful, make sure to like, subscribe, and turn on notifications so you don't miss out our next updates. Thank you for watching. Stay sharp, stay informed, and I will see you in the next one.